Good morning, everyone. My name is Vanda Vickers, and I'm the Chief Operating Officer at the Global Risk Institute, and I'm happy to welcome you to the fourth webinar in the series, Managing Risk Through and After the Pandemic. The aim of the series is to help board members and risk management professionals assess the economic implications of the current crisis, with an eye towards managing risk and building resiliency going forward. Today, we are thrilled to welcome William White, who's the former chairman, OECD Economic and Development Review Committee, who will discuss monetary policy and financial stability in the transition. Before we start today's webinar, please note that your microphone has been muted. You'll have an opportunity to ask questions to our speaker by navigating your cursor to the middle of your screen, clicking on the little circle chat box, and typing in your question. Following an introductory presentation by William, my colleague Jason Stewart, who's an executive in residence at Global Risk, will begin the conversation with a few questions of his own. Towards the end of the session, I'll re-enter discussion to share audience questions. When you leave the webinar today, a survey prompt will appear. Please ensure that you fill out that survey, as your feedback is very valuable to us for future programming considerations. Today's session will be recorded for future use. So now let me introduce William White. I'm fully introduced. Bill is a global expert in the field of monetary and fiscal policy and financial markets. He has a unique perspective based on his multi-decade experience in these fields. He was the chairman, as I mentioned, of the OECD Development Review Committee, and he began his professional career at the Bank of England and subsequently spent 22 years with the Bank of Canada. He was appointed advisor to the governor in 1984 and deputy governor of the BOC in 1988. Bill joined the Bank for International Settlements in 1984, becoming the economic advisor and head of the Monetary and Economic Department in 1985. At the BIS, he oversaw the preparation of its prestigious annual report and had overall responsibility for the MED's research. He's also a member of the BIS Executive Committee. He has, in recent years, published many articles on topics related to monetary and fiscal stability. So it is my great pleasure to introduce William White. William, over to you.
Well, thank you. Thank you very much, Vanda. Just trying to get up my first slide here. I may need some help on this, I'm sorry. Well, let me start off by saying thank you very much for the invitation to be here. It's a great pleasure to be able to address the Global Risk Institute on and express my views on how I think these risks are unfolding. So do I have the slides, please?
You do.
I can't see them. Is the first one up?
Yes, it is. I'm on the second. Monetary policy leading up to the crisis of 2008 is showing.
Okay. I can't see the slides on my screen, unfortunately, but that's okay. Let me start with a quote from Rab Butler. He was the Deputy Prime Minister of Britain when I was doing my PhD at the University of Manchester. And his autobiography was called Politics, the Art of the Possible. And not long after, John Kenneth Galbraith, a great Canadian economist, retorted, "Politics is not the art of the possible. It is choosing between the unpalatable and the disastrous." And I guess one of the themes that I want to make here is that we have had many opportunities to make hard choices in the past. And over decades, we have refused to do so. And every time there has been a problem, the answer to that problem has been either easier monetary policy, easier fiscal policy, an unwillingness to tighten up during the upturns, and the upshot has been a consistent increase in debt, both public and private. And now, of course, we've had this pandemic. which is debt accumulation on steroids. And the question that I really want to ask today is whether the time has at last come to start making some hard choices. And to inform that discussion, let me give you my views on two things. The first of which is, how did we get into this mess, this debt overhang problem? And then the second question that I want to address is the question of what's the possible kind of new world we might want to move towards, and what sort of opportunities might this pandemic crisis actually present? So let me begin with the first issue, which is, how did we get into this? Monetary policy leading up to the crisis of 2008. I guess my view is that the crisis of 2008 was basically a bust after a previous credit boom of the sort that we have seen repeatedly in history, and which unfortunately people don't teach in courses of economic history anymore, because they don't teach economic history anymore. What led up to the crisis, what led up to the boom, was really three things that were in themselves good, but when you put them all together, they contributed to a very bad result, which was the crisis itself. Now, what were those good things? Well, the first one, I think, was demographics, the fall of the wall and global disinflation. And what I mean by that was that through really the 1980s, the 1990s, and afterwards, we had massive positive supply side shock that came in two forms. One of them was the baby boomers going through in the advanced market economies. And the second one was the fall of the wall and the bringing back into the global production chain all of the labor of those countries that had particularly been previously been command and control economies, like China and Slovakia and all of the countries of Eastern Europe. And that put a tremendous disinflationary impetus into the global economy. That in itself was a good thing. But then we had two other things that came along that, in retrospect, were not so good. One of them was easy money. And as I've already referred to, whenever there was a downturn, easy money and fiscal expansion were always the answer. But when we got into the upturns, there was never the same degree of tightening. And so the upshot was that interest rates ratcheted down, and government debts and private sector debts ratcheted up. And that was not such a good thing. And then, of course, we had financial innovation in the advanced market economies. And we're all aware of subprime and market-backed securities and all that kind of stuff. So if the easy money led to a big demand for credit, the financial innovation led to a big supply of credit. And when you put all of those things together, it led to the financial imbalances that were building up prior to 2008. For those who lived through it, you will remember we saw savings rates, household savings rates in the English-speaking countries go down to zero or even below. We saw the VIX get to record low levels. We saw the credit spreads go to record low levels. We saw the equity prices go to record high levels, leverage, all of that stuff, which sounds sort of familiar, and I'll get to that in a minute. All of which were in some fundamental way linked to debt. And they spread to this boom-bust thing then spread to the emerging markets, basically via semi-fixed exchange rates. The advanced market economies, in easing their policies during the downturns, basically we're saying, if we have a problem, we can print our money, we can print the money to get our currencies to go down. And the emerging markets basically said, well, if you can print the money to get your exchange rates to go down, we can print the money to prevent our exchange rates from going up. And so we had this incredible boom leading up to 2008. And of course, it was an accident waiting to happen. And it did happen, the inevitable bust that followed the boom. And I'd say, without going into any explanations or detailed explanations, the policymakers all missed it. And I was the head of the economics department at the BIS, and I was right there at the center. And I watched it all happen, almost as it were a kind of Greek tragedy. So that's what happened leading up to the crisis. Sorry, can I have the next slide? There we go. Now, what's happened since? In some fundamental sense, what has happened since is just more of the same. If the problem before was this consistent response of monetary and fiscal easing, we had the same thing after 2008. And it was based, I think, in two false beliefs, and that's basically going to be the title of this chart and the next chart. The first false belief was that monetary stimulus will be effective, that it will actually work to increase aggregate demand. I think there's a lot of reasons to believe that that assumption was not true. And in fact, I guess the best proof we have that that assumption was not true was we had 9 years in a row leading up to 2019, 9 years in a row when both the Fed and the IMF and the OECD said that next year would be a much better year than last year. And then it never happened. Okay? And those forecasts were all based on the idea that the monetary stimulus would be more effective than it actually proved to be. Now, why is that so? Well, one reason I think is that when people do really extreme things, and since 2008, we have done some pretty extreme things. I'm thinking about credit easing, quantitative easing, Operation Twist, forward guidance, you name it. One of the problems with really unorthodox policies like that is that they do smack of panic, and they make people feel uncertain. And when people are uncertain, what they do is they don't expand. They don't belly up to the bar. They hunker down. And so I think that has been a problem. Perhaps even more fundamental about monetary stimulus is that it works through bringing spending forward that would otherwise occur later because the discount rate is lower. So you bring your spending forward using debt to do so, but it only works for a while. Because if you're spending today, what you otherwise would have spent tomorrow, when tomorrow becomes today, the money's already gone, and you've got the debt to show for it. So there is, I think, a fundamental, what in the jargon, a fundamental intertemporal inconsistency in the repeated use of monetary policy. It does work at the beginning, but its usefulness recedes or gets smaller over time. And when you look at the particular components of spending, it seems to me that there are all sorts of reasons why both consumers and the corporate side didn't increase their spending in the way that the models might have said they would. One of them, I mean, thinking about consumers, if you're saving for your retirement and the roll-up rate on your savings goes down, in a sense, you've got no choice other than working longer, but to save more. On the corporate investment side, something I think maybe we'll come back to in question time, a much overlooked issue has been that the companies have been buying in shares, particularly in the United States and the UK, and it's been spreading out. Companies have been buying in shares. And they've been doing so in order to push up the share price, to push up the bonuses, to push up the money made by the management. And the way that you do that is by issuing debt and making the corporations more insecure in some fundamental sense, okay, or by cutting investment and reducing your cash expenses. So anyway, I could go on with all sorts of other reasons why it's less likely to be effective. But I would just note, and of course we don't teach the history of economic thought anymore. Keynes himself said this in 1936 in the great in the General Theory. And I think the line goes, if we are tempted to assert that money is the liquid that activates the system, we had best remember there are many slips twixt the cup and the lip. So even Keynes, the great Keynes, felt we had an issue here. Well, the second, can you get this thing? No. Sorry, next slide, please. It seems to have been, there we go. The second false belief is that the stimulus will have no harmful side effects. And I think we're seeing increasingly that indeed monetary stimulus in particular does have undesired side effects. I've referred repeatedly to debt. The IIF in Washington, the Institute for International Finance, calculates these numbers, and their contention, their latest numbers indicate that global debt, okay, as a proportion of GDP between 2008 and 2019 rose from 290% of GDP to 230% of GDP. So for people who think that a crisis is a time for deleveraging, all one can say is think again, because in this particular crisis, we wound up with global debt ratios that are even more threatening at the end than they were at the beginning. And that, I think, is a real problem. And not least, much of that increase has come in the form of increased debt in emerging markets. So to some degree, prior to 2008, we thought about the emerging markets as sort of part of the solution, China in particular. Not this time around. This time around, the emerging markets are part of the problem. So that's one side effect of stimulus. It has led to record high global debt ratios. The second thing is that what we have done is actually fostered financial instability. Now, why do I say that? There's a number of reasons. One way in which financial stability is threatened is by weaker financial institutions. And what I would contend, and these institutions would themselves contend, that the squeezing of margins by the reduction in interest rates right down to zero has squeezed the margins so greatly that for many of them, it really has become a threat to the business model. And you see this specifically with respect to insurance companies, pension funds that are increasingly underfunded, and even the banks themselves, who've got alternative sources of income, charges, etc., becoming more and more worried about the side effects of monetary policy on them. And in addition, of course, because people are threatened, or the institutions are threatened, there's a tremendous tendency to go for risk, to try to go for riskier investments in order to get your rates of return up. And that's just fine as long as the bets don't go wrong. But that's the real worry that we've got looking forward. And financial stability is also threatened by badly functioning financial markets. Markets that have got mispriced asset prices or markets that fail to function. And when you go back over the last 10 years, and I just list them out here, we've got $17 trillion of negative bond yields, record high PEs, almost record low credit spreads in the VIX, risk on, risk off as opposed to value investing, flash crashes, market anomalies, no market trading for days at a time in JGBs in Japan, and most recently, of course, the Fed's loss of control, somewhat regained, loss of control over the short-term money markets in the States. So there's a lot of things to be worried about here that I think have been the side effects of what we have done. The last thing, of course, is the potential growth threatened by weaker financial institutions. Zombies that are kept alive by weak financial institutions. Capital misallocation. Think about all the unicorns, many of which are going bad. So there's all sorts of problems here, even pre-pandemic. And the question I raise here in the last bullet, a still bigger accident waiting to happen. The problem, in a sense, as we think about, next slide, please. The problem that we think about the pandemic, it's a bit like a patient with preconditions, and that's what I think this pandemic is likely to bring in consequence. The pandemic is truly been unique because it isn't the pandemic that's caused the recession. It's the lockdown which the governments themselves have proposed that's caused the problem. And in response to what they have done in terms of the lockdown, of course, we've had this unprecedented policy responses, massive increase in both monetary policy stimulus and financial stimulus. That has supported a near-term bounce, and there's no doubt about that. I read this morning in the paper, the NASDAQ, the S&P, they're all back up to pre-pandemic record highs. So we've had a near-term bounce. But the real question is, can we continue? And there, I think, all of the things that I spoke about earlier, which I often referred to as headwinds, restraining both demand and supply, really mean that longer term, none of this rebound, or at least not all of this rebound, is justified by the underlying economic concerns. So to me, I guess the thing that I worry about most is that all of those preconditions will lead us into a situation of recurrent debt, deflation, and perhaps even worse over time. And I would just remind you, too, that insofar as the virus is concerned, if you believe the epidemiologists, that in the end you will wind up with herd immunity. The implication is that we may have to deal with this thing going forward, and that is going to be a problem. So we have risks to financial stability. In a nutshell, if the debtors can't pay, the creditors don't get paid. So let me move, and political stability, I'll talk about that in just a moment. Next slide, please. So the next question is, where do we want to go? And I'm going to be very brief on this because I want to get to my last slide. The real question is where we want to go. I think we need an analytical revolution. We need to think about the world, the economic world, the financial world, the social and political world, the environmental world in a very different way from the way we thought about it before. And this particularly applies in the economic and financial realm. We've got to embrace complexity. The world is not as simple as the models say it is. It is much more complex and much more adaptive. That's the first thing. It's almost a philosophical change. We need a sustainable financial system, and all my comments indicate that we are not there yet. We need a sustainable production system. The environmental issues, we're not green enough. We need a sustainable political system. We have all seen the people in the streets in the course of just the last few days, all around the world, suggesting that there's something there that really needs change. And I think we may need institutional change in order to get that. So where we are is essentially non-sustainable, And what we need to do is we need to move to a sustainable world. Now, I've got the next slide, which will tell us how to do it. How do we get from here to there? I don't really have enough time. I think I've over-prepared here. But there is a way forward with respect to each of these things. But the central point that I would make is the following. That if we raise complexity and we need more resilience, that means we will need less efficiency, and that's going to be costly. On the debt question, the debt restructuring, we're all aware it's going to be costly. On the environmental issue, adaptation to climate change is going to be costly. The mitigation of climate change, okay? Stranded assets is going to be costly. A better deal for workers, costly. And then the question, and in the background, of course, I'm raising again this issue of the what's the word? The question of the unpalatable versus the disastrous. How do you convince everybody of the need for change? Last slide, please. Let me, with all of that as background, sort of suggest that this is the opportunity to move to a different world. We wouldn't choose the world we're in if we had the choice. We've got the opportunity to move to a different world. My fear is that this is not going to happen, that there are just too many constraints and too many costs that people are unwilling to bear. So let's just talk specifically about the debt overhang. And of course, implicitly, the implications for risk and for systemic stability going forward. For many, at the moment, the current debt levels are unsustainable. And that is clear already. The bankruptcy rates are starting to rise. The ratings downgradings have risen dramatically. The debt levels are unsustainable. What are we going to do about it? There's a number of alternatives, but none of them are without difficulty, and some of them are impossible. Austerity. Austerity works for one person, one household, one corporation, but it doesn't work when everybody or a large number of people are trying to do it. And this is where you get into what Keynes called the paradox of thrift. If I spend less, you receive less, and in the end, you wind up worse. We all wind up worse off through trying to be thrifty. A second way out of this thing, historically, and we've seen this repeatedly, is good luck. Sometimes spontaneously you get faster real growth, and over time you can grow your way out of the debt problems. That's possible, but given all of the stuff that I've just outlined, I don't think it's going to happen. The third thing that we can do, and I think this is what people are going to try to do, I'm sure, is that they will use fiscal expansion supported by financial repression, and it might just work. And that is to say, if the financial markets are prepared to give enough patience to the governments to continue financing them, even as they continue to expand their fiscal stimulus in order to jumpstart the next downturn, that might well work to give us the growth that we want. In the limit, it might even bring back inflation, which to a limited degree we do want. However, in order to gradually eat away at the debt and the debt service in that fashion, you have to hold down the interest rates below the rate of growth of the nominal economy. And the question is whether in the modern world it's even possible to do it. That's what happened after World War II. Okay? When the interest rates were held down, inflation went up, the debt gradually disappeared. But the question is, can it work in the modern world? And if it doesn't work, okay, so that you can't hold the interest rates down, it does seem to me entirely possible that you can get into a situation where the interest rates do start to rise. But this just increases government debt service because of the magnitude of the government debt. That in turn leads to fears of still higher inflation, still more pressure on interest rates, and in the end you get very, very high inflation. So I guess I will finish by saying restructuring debt is unpalatable, particularly for those who hold it. But it may well be that in the end, accepting some limited losses, the unpalatable, beats the alternative. And I always put at the end of my slides when it's a program such as this, good luck. You just might need it.
Thank you, Bill, for that insightful briefing. I think that I'll like to turn it over to Jason to start the question and answers with our audience. I'll remind everybody that if you'd like to ask a question, please submit it using the chat box feature. You just take your cursor and there's a little circle with chat. You can ask it there, and I'll be moderating questions after Jason opens it up for us. So over to you, Jason. Thank you.
Thanks very much, Vanda. Bill, you talked about the factors over the last 3 decades, which on a secular and a fundamental basis helped suppress inflation and keep interest rates at ultra low levels in recent years. How do you see these inflation suppressing trends going forward? Do you see them continuing or changing?
Well, I think the fundamentals that brought us these sort of disinflationary pressures, I think are actually going to go into reverse. But of course, before we will see, and I'll say a word about that in a second, but before we see that, we're going to have to get through this disinflationary period, deflationary period arising from all these headwinds. Okay, so we've got that sort of pressing prices downwards. But underneath it all, the things that brought us disinflation earlier, I think are going into reverse. So the demographics, for example, which was a big element of it, and globalization, the demographics, the baby boomers are rapidly coming to the end of their working lives. Okay, so that's a big negative supply side shock. And then we have deglobalization. So 2 elements in a certain sense is globalization has gone to a point where the scope for further globalization is much reduced because we've already done a lot of it. But in addition now, we've got all of these political rifts that are arising that are going to lead to deglobalization. And in addition, the recognition on the part of the corporations that the supply chains have been stretched too thin, and that to some degree we've got to rethink how we do things in a more resilient way. So that too is going to contribute to, in a certain sense, less efficiency in the interests of more resilience. All of those things in the fullness of time will push prices up. And my worry is that the governments will, and the central banks, will not recognize this underlying factor, and they'll allow inflation to get started and say it's okay, and will allow it to go into overdrive in a way that they hadn't anticipated.
Thank you. I'd like to also pick up on the massive quantitative easing expansion by the Fed, ECB, and the Bank of England, and the new introduction of large-scale QE by the Bank of Canada. Looking ahead, what challenges do you see in communicating major changes to QE? And what risks do you see in undertaking a future winding down of QE over the medium and long term?
Well, this I don't think I used the words in my presentation, but I probably should have, which is that we're confronted with a kind of debt trap. And you hear people using those words sort of with increasing frequency. And what I mean by it is that you get into a situation where there's so much debt and there's so many imbalances that you know you'd like to raise interest rates and stop the process, but you can't do it because you're already so deeply into the process. The debt levels are so high that were you to seek to normalize things, you'd create the very problems that you're trying to avoid. And so when you look at the post-2008 period, for example, we had a whole decade of ultra-easy monetary policy, which on various occasions people tried to reverse. And what they saw was that the whole edifice started shaking in such a way that they had to back off. And I'm thinking about the temper tantrum. Do you remember that in June of 2013?
Yes, the taper
and then,
tantrum.
Of course, and then in 2018 and 2019, when the Fed was trying to tighten up, and in the end became convinced that they actually had to ease up, and they started easing up well before the pandemic. So this just indicates the extent to which we're now sort of caught in a situation where it's not so obvious what you can do to get out of it. And if you have a world in which the Fed, as with the temper tantrum, where the Fed has to give the market what it expects, and what the market expects is what it wants, then you can see that we're in a situation where you really don't want to be. So the communication here is going to have to be done very, very carefully. And in fact, I'm not sure that just words are going to be enough to get us out of this situation.
Picking up on that, as we talked about the normalization, if I was to look at the other side, what options are left if there's a second outbreak in a major way of COVID-19, or if the economic recovery that's expected in the second half of this year and next substantially falters? And in particular, I'm looking at the Bank of Japan's responses over the past 2 decades. If you could comment on your views about central bank purchases of equities and yield curve control.
Well, once you're this far down the path, there will be a tremendous, pressure to continue. Not least because not continuing down the path is almost an admission that the path was the wrong path, and it's very hard for anybody to do that, whether in the field of economics or wherever. So I suspect that there will be a kind of doubling down as we go forward. And we have in fact seen the Japanese in particular do many of the things that you've already talked about. Yield curve control in particular. The Japanese too have bought very large amounts of corporate bonds and equities, I think, through ETFs, and the Fed it is not impossible that this will happen. Now the question is, will it work? And thinking about yield curve control in particular, I mean, yield curve control basically says we're going to keep a long rate at X, and we will buy central bank. We will buy whatever you want to sell. And this is a bit like a currency peg. It's just fine as long as nobody puts you to the test. But the question is, will people put you to the test? If they don't, well, then we're back to the sort of the financial repression that I was talking about before, and it might just work. But if they do put you to the test, and then the central banks wind up having to buy all the securities that there are, and I remind you that when a central bank buys in securities, okay, and creates reserves against them, all they're doing is they're changing long-term government debt into the shortest possible form of government debt, which is overnight reserves at the central bank. which is itself owned by the government. Okay, so that's what that transformation does. And you can see that when people observe this going on, there might be a tendency to head for the exits. So it might just work, but it would be unwise, it seems to me, to underestimate the possibility of it not working.
And we've gone down the continuum of policy options. So my last question before turning it back to those from the attendees, your perspective on the vocal group of modern monetary theorist advocates in terms of fiscal deficits are essential to achieve full employment and that monetary policy's role is to be supportive. What are your views of MMT and its merits and problems?
Well, the fact is that over the course of the last 10 years, okay, when you see what's actually been done, it's not far away from what the MMT people want, which is there's been a massive expansion in government debts, okay, particularly in the advanced market economies, and it's been matched, not dollar for dollar, not sort of issue by issue, but it's been matched by a massive expansion in the central bank's balance sheets. So it's not a million miles different. Now, the good news is that they've done this, and it hasn't resulted in massive inflation. But the good news is also the bad news, because what it means is that since we've already done something equivalent to MMT, and it hasn't gone wrong, the implication is we can do still more of the same. And my concern, it's like this joke. You know the joke about the guy who jumps out the 20-story window? And he's going past the second floor and someone shouts out, "How are you doing?" And the guy says, "So far, so good." Well, that's the sort of situation, because the world is, as said before, of complex adaptive systems. Complex adaptive systems are highly or nonlinear. Unfortunately, most of our economic models are all highly linear. Right? So the really bad things, they're not being modeled. And the difficulty here is that one presses on because bad things haven't happened. I think we're buoyed up by the theory of modern monetary theory that says it's all okay. But what you're doing is, one, you're running the risks of still more of all of the imbalances I spoke about before, okay? And the MMT people don't recognize this stuff at all, okay? But they're real, as one of my earlier slides seemed to indicate. And the second thing that they don't recognize is the possible nonlinearity in the responsive inflation,
yes,
which is everything's fine up until now, until it isn't. So in a way, I find the modern monetary thing, particularly because it's got a kind of ideological sort of thing, a bit unsettling. And I'm not sure how widely it's known, but I mean, modern monetary theory is really just a retake on a thing that was referred to as functional finance by Abba Lerner, when he got into a big debate with Keynes in 1943 in Washington, as it turned out. And Keynes' skepticism was made clear when, at a certain point, he said to Lerner, "No, that's just humbug. The national debt can't rise forever." And that's basically what, it's almost as simple as that. So there's an element of truth in it, but if you push it too far, I think it could lead you still further down a path that I think we've really gone we've gone down too far already.
Thank you. Vanda?
So we've got a few questions here from our listeners. One I'll start with, do you expect negative interest rates to be established in North America? And what would be the consequences if they got established?
Well, negative interest rates, as you know, we have them now. We have them in Switzerland. I was living in Switzerland when they were brought in. The ECB's done it. The Riksbank in Sweden has done it. It is interesting that the Riksbank has actually started to pull away from it because they have been saying both publicly and in private that they worry about the unintended consequences. I actually lived through some of the unintended consequences because when they brought in negative rates in Switzerland, they charged the banks for the reserves that they were holding at the Swiss National Bank. The first thing that Credit Suisse did was to raise the mortgage rates. And you might say, but shucks, the whole purpose of the exercise was to ease credit conditions, and now they wound up tightening. But once you factor in the fact that the banks have got to make a profit, you realize that this might well be the implication, that they can't get they don't want to lower the deposit rates below zero. So they've got to maintain their profits somehow, and they're being charged this penalty rate at the central bank. So the answer is you raise the rate on loans. Mm-hmm. So it's a bit like, what's the word? It's a bit like quantum mechanics, you know. When you get to zero, maybe everything changes. It's a phase shift. You know, the world doesn't work the way you think it does when the particles get too small. So the Fed has said that they're not going down that route. I think they've been very, very clear about that. But in crises, it's often the case that people say one thing and then in the end wind up doing something else. I think that the practical impediments to it are also significant, which is that you can always take the money out in currency. And then the question becomes, and we've had Ken Rogoff's written a whole book about it. You know, what you need is just electronic money. That way people can't get away, can't get it, you know, can't draw out the bills because there aren't any. Mm-hmm. And then you just say -3, -6. My concern, as my slides tried to indicate, is that those policies are not likely to be effective. And the more you go down that road, they're not likely to be effective. And they are likely to have unintended and undesirable consequences. I'm hoping that the central banks, particularly at the Fed, are getting that message.
All right. Here's another question about specifically, if you were an investment manager of a significant pension fund, what would you be doing differently now?
When I was at the Bank of Canada, people used to ask for my investment advice just so that they could do the opposite. I got locked into I took out a 22-year mortgage at 22% at one point, which tells you all there is to know. The honest truth is I don't know the answer to that. I think, for example, and I sympathize with the questioner's situation. You know, I used to think in the old days about a standard 60-40% mix. You know, 60% equity, 40% debt, government debt, good debt. Now, and part of the logic was the implicit diversification, that if the economy went south, the equity prices would go down, the interest rates would go down, and the price of the bonds would go up. So you were diversified. It's finished. You know, if the bond rate's zero, pretty close to it, there's no place for them to go. The whole portfolio strategy has got to change. And then you say, well, maybe you should sort of get more into equity, you know, or into risky things. But I think most pension fund managers would tell you that having gone into alternative investments, you know, infrastructure, airports, there's not to say those decisions were wrong, but and might well prove to be prescient and good going forward. But only to make the point that if you have a world in which the only alternative is to take on still more risk on behalf of people like middle-class pensioners who can't afford the risk, this is not a path we want to travel on anymore.
How about we pivot to our governments and maybe a finance minister looking at from a finance minister's point of view, austerity is bad, continued spending leading to unsustainable debt is bad. What should our finance ministers be doing now that where we are today?
Well, I think I made reference before to the patience of the markets. If you do some of this intergenerational accounting, Larry Kotlikoff and these people, where you look at all of the promises that governments have made with current legislation, and then you look at the tax revenues expected on the basis of current legislation, and then discount everything back to the present. Virtually every major government in the advanced market world is insolvent. And the markets don't care. And they haven't cared for a very long period of time. And I think that insouciance will probably continue, that the finance ministries of most of the big advanced countries in particular, but many of the emerging markets too, the markets will cut them some slack, and they should use it. But having said that, it's a bit like the point I made about inflation, so far so good, that you can push it further, but you can't push it forever. And so what the ministry should be doing, it seems to me, is pressing on with the kind of stuff that with the stimulus that they're doing as long as they feel that it's needed, and then start thinking about longer term, how can they get this thing under control? And one hopes, in the most optimistic of cases, that, as I said before, that the fiscal stimulus, together with financial repression, does work, the economy does recover. And then in the upstage, not in the downstage, but in the upstage, the governments have got to make credible promises that they know there's a problem here longer term, and that they intend to do something about it. And how you lock it in exactly in terms of legislation, debt breaks of some sort, for the future, not for today. Okay? I think that would be a very good idea. Going forward, it may well be that with governments as well as, I know this is a radical thought, but that with governments as well as on the private side, that there may have to be more reliance on conditional obligations. Ken Rogoff again, I think many years ago, or maybe William Biter, I can't remember, proposed government liabilities that were conditional on economic performance. So that if the economy did well, your service payments did well. If the economy didn't do well, you didn't do well. So I don't know. There's going to be inventive ways of thinking about these things going forward, and that invention will be spurred by the fact that people will become increasingly concerned that they've pushed it too far. There's still room, but there's not an infinite amount of room. That's the only point I'm making.
Bill, thank you so much. I think that you've given us all a lot to think about and to ponder, and information that will help us all manage through the next phase of this financial recovery. And I wish we had more time. We're coming up to the top of the hour already, so we're going to have to close it off here. But on behalf of everyone who's participated today and everyone at GRI, thank you so much for being our speaker here today.
Thank you for the invitation.
Great, thank you. So as I mentioned at the start of the session, when you leave this webinar, a small survey will appear, so please give us your feedback. And we have a couple of upcoming webinars for our members. Tomorrow we have scenario analysis and economic financial risks from climate change, which we have a couple of speakers from the Bank of Canada joining us. And we have actually on Thursday another a webinar on actually dealing with cybersecurity and privacy issues. And both of those will have been sent to you as invitations if you are on our GRI mailing list. So thank you very much again, Jason and Bill, and we wish everybody a great day. Thank you.
Thank you.